Greetings, everyone. This is international fundraising for non-US business owners and non-US businesses. And today we're going to talk a little bit more about some practical problems, things that you need to realize when you're going international. And you're an international non-US business, you want to access the US fundraising market, US investors. You want to access, you need to realize that US investors, accredited investors, have a lot of their capital in regulated institutions like private banks, regulated trustee companies. If you're going to be dealing with them, with broker dealers, with basically people and all the money that's in the majority of the money in the world, well, I don't know if the majority, but a lot of the capital of the world, the people that you would probably want to deal with are regulated persons and regulated investors. We are not talking about large multinationals, people who have multinational type companies where, you guys don't have these kind of problems. Apple doesn't have a problem operating internationally, nor does Google, and nor does BlackRock and Vanguard and State Street and all these massive private equity funds. These guys don't have the problems that we are talking about. The problems that we're talking about apply to small owner-managed businesses, family-owned businesses that are dealing worth less than $100 million, trying to raise or want to raise or will want to sell or exit for 10, 20, 100, 50 million, 60 million. Anyone in that space who's not international wants to access capital from the US, either for exit, for acquisition, for growth, whatever it is. This is, you are the guys that we are talking to. And you basically have a holding company, whether it's in Uruguay, US, Canada, UK. You have a holding company and you have an operational company somewhere in South America or in Africa or somewhere outside of the US in the Caribbean. You're doing great business, you've got good plans, or you're ready to exit, or you're ready to make an acquisition. All and anyone in these situations, and you're under $100 million, as the global financial system, which is divided into regulated and unregulated, increasingly becomes transparent, as in the compliance departments of regulated institutions now have automated compliance scores run by algorithms. They have artificial intelligence, they have automation, they have all these things. Soon they're going to have quantum computing, which means that they can do lots and lots of detailed analysis very quickly and cost effectively. And this is going to overall make the system more transparent. It's going to flag up risk, and regulated institutions, investors, advisors all want to do less risky transactions, because there's a cost to risk. It reduces your profit margin, and if people do take risks, it's going to be calculated risk, as we all know. So that's the situation that we find ourselves in. And so one of the things that I notice and that kind of I struggle with is that we deal with lots of owners and families, whether it's providing advice or services or both, and families in particular from South America will, they set up trusts and companies, and they move their wealth management, and sometimes they have businesses in the US, property in the US. They undertake their wealth management, in the US. They're using regulated private banks, large private banks like JP Morgan, Morgan Stanley, and then there's like second tier private banks, which are smaller. There's a ton of them. Investment banks, they're using regulated trustee companies. There's a lot of those, in Florida and Miami, where we spend a lot of time. There's a lot of, a lot of families, of course, use the regulated financial system to protect their accumulated wealth. and to expand it into, by entering into the U.S. domestic wealth management system, which is great. And they deal with all the big brands, the big, all the big brands, whether it's J.P. Morgan Stanley, Bear Stearns, Bank of New York, the ones in the BB&Ts and the Truists, and there's all these companies that are large, regulated, well-known, trustworthy brands and institutions, Wells Fargo, Citibank. That's all great. That's absolutely great. I have no problem with that at all. But you, our colleagues, and again, we're recording this video because we're tired explaining this in meetings over and over and over and over again. It takes a lot of time to explain. So it's time to commit this stuff to video so that we can allow people to listen to the videos, as opposed to me having to take 2 to 3 hours out of my day to come down to Miami to go through the realities of what you're facing, or why you're experiencing the problems, the delays, the costs, and you're going around in circles, and these are the problems. When you place all of your accumulated wealth in wealth management environment, a regulated wealth management environment. Now, again, we're talking about owner managers and families, and you may still be building wealth. The family may still be in the process of building wealth. You haven't exited from the family business that was 150 years old. That's a different set of people. And if the family have exited the business and you're just doing wealth management, you're good. You're good. You can exit the system. You can now relocate your capital to the US, or you got it there and away you go. I'm not talking about you guys. You guys are all fine. Your guys' focus is on investing in the US and doing all the great and good things that you love, and that's great. There's a bunch of families, though, that are still in the first generation of setting up a really successful business, or their second generation business. They're driving it. They have some accumulated capital, but that capital is needed to be leveraged or access to continue to grow the business, to fund expansion, or to fund acquisition, or to fund cash flow, or to fund transformation to the next thing, or just to fund ongoing growth and business. Working capital is needed to finance certain things, and to do to collaborate with others, or whatever. When you need funds, you have access, and your funds are in a regulated environment in the US. Yes, they're protected. Yes, they're in US trusts, and they're confidential and all that stuff. That's great. That's absolutely great. But if you're running an international business and you have a holding company in Uruguay or Canada or US or Canada or UK or wherever, an operational company, and now you need to access those funds in the regulated environment, you've created a kind of a problem for yourself, because your private bankers and their compliance departments, of your private bankers and your trustees, are going to have a real problem with actually interacting with your holding company and your operational company. I remember one year one of our team went to Colombia a couple of years ago. It's quite amazing. They were checking into a hotel, one of the Marriott hotels, and she actually had to fill out a source of funds form, which is quite interesting, because so we took a look at the form, and the company that owns the operational entity in Colombia is in the U.S. So the banking is being done in the U.S., but the company, the operational company, is in Colombia, which is a hotel, but the holding company is in the U.S. And so, of course, what's happening is you'll pay locally in Colombia, but the funds ultimately are going to transfer from Colombia up to the U.S. But of course, what has to happen is to receive that money in the U.S., the banks in the U.S. are probably saying, hey, what's your source of funds? Yeah, you've got a hotel, but how are you going to demonstrate to us that this is a clean source of funds? And so what these people have had to do, they have to make their guests sign a source of funds form, in order so that basically on the macro, that they can basically then transfer those funds from Colombia up to their US bank, without too much problems, because now they have a source of funds declarations from all of their clients, which is amazing to me. I mean, I've never seen that before in any other jurisdiction, but I completely understand why. It's for all the reasons that we're saying. The system is becoming more and more transparent, and banks and everyone else can point and say, yeah, we want to deal with your $100 million a year or your $50 or $60 million a year, but these are the compliance problems that it presents. So when you have a growing international business and it's not regulated, and you have your capital and you're accumulating your capital in regulated platforms, which is protected, it's great. It's in the US and you've got confidentiality and tax benefits and all these other things. That's fantastic. But, first and foremost, now you've created a challenge between, if you want to leverage that capital for the purposes of your holding company and operational business, you're going to have problems. And you, the people who I'm talking to, you know what I'm talking about. You guys have those challenges every day. And so, the other thing, though, that I didn't want to talk too much about the transactional side, which is basically why you should have a regulated platform that enables you to enter into, acquisition transactions, exit transactions, routine wire transfer transactions internationally, and all the rest of it, and fundraising transactions. What I want to talk about now is more things that impact the families, because we deal, of course, with owners. They're people, they have families, and, the welfare of the family, of course, is highly connected to the welfare of the business. And so in business, in life, problems happen. And when an international business has problems, so let's say you're running a holding company with an operational business and you run into some certain types of problems. Now remember, you've got all your accumulated savings with a large global trustee company somewhere in Miami or something like that, where their compliance department is on steroids. If a rat breaches rules anywhere in the world, they know about it, because they're constantly monitoring, the world with their AI and all the rest of it, their AI compliance, because they can afford those systems, and that's great. It protects your money, but they know everything. So you now have problems. They find out about it, of course, because they're monitoring all the news, they're doing all the automated analysis, and now they know that you have a problem, and they write to you and say, hey, you've got this problem, so we're putting you on notice. They could either freeze funds, put you on notice, they could file a suspicious activity report. The likelihood of that happening is going up. And yes, for a long time, suspicious activity reports were piling up. But what's happening now, of course, as systems become more digital, those suspicious activity reports are going to be processed and they're going to in the system start to impact your compliance risk score. I mean, have you ever heard the discussion amongst Americans of their credit score? And there's a whole industry behind the things that you should and shouldn't do to impact your credit score in the United States. It's just a matter of financial survival. It's a system. It's a reality. Well, when you're international, your international risk score is, there isn't a formalized system for it yet. But I think ultimately that's where it's going to eventually head. Somebody's going to do that. This is going to become an issue for you. So your ability to access your savings that you need for your business is going to be, could be restricted in a crisis. The other thing that families have to consider when you're running an operational, unregulated business and you're doing good things like saving, you're protecting your money with good trustees and private banks and all these brands and these great big firms in the US, that's all great, but there's a middle ground, because what you have to realize is this: in a crisis, you may not necessarily be able to access the funds in those trust companies, private banks, because it's a crisis. The global financial system is more transparent. You're not going to be able to get on the phone with your compliance department in JP Morgan and explain to them why these things are being said about you in on this blog, or why your name of your company or your firm is caught up in these news stories, or whatever, or this person is saying this about you in some blog or whatever. You're not going to be able to get on the phone and explain that to them. Your relationship manager is not going to be able to get on the phone and talk to the compliance department either, no matter what he tells you. He's not going to do that. Not unless you're worth 500 million. If you're worth 500 million, you're not going to be watching this video, because you're not going to have these problems that I'm talking about. So I'm talking about the people who are whole international enterprises that are less than $100 million. So in a crisis, you are not going to be, or you're going to have restricted access to those funds, because until, and your ability to explain the problem and resolve situations is going to be severely delayed. Because the other thing you got to realize is this: when you have 10, 20, 30, 40 million dollars, and I've seen this for years, at these global private banks, that's actually small to them. I have seen clients with $100 million, and in a crisis, they can't get their relationship manager on the phone for like 3 to 4 days. I've seen that. And so that could happen to you. And these large global banks the system is becoming more transparent. They're able to pick up more things. And what's happening is the service level is decreasing. Service level is decreasing. When if you worked hard, you've got 30, 40, 50 million dollars. I mean, in today's world, you're on top of the world. I mean, that's a lot of money that can look after a family. It's great. But macro global, the banks, the large global banks don't look at you that way, because you're still, like if you've got $15 million in savings, you're small. You're almost retail to them. And that's the way they treat you. Your ability to get customized solutions, resolve problems in a crisis is actually very low. And it's getting lower all the time, because these banks, to manage costs, they have hundreds of thousands of people with 15, 20, 30 million dollars, these private banks. They're automating processes and risk. They're automating it. They don't have it. They can't hire another 100,000 people to have discussions with you, the client who has, $20 million with them. They can't. So this is getting worse. This situation is getting worse. And so if you are running an unregulated business, unregulated in the sense that you're using a holding company and an operational company, and you're putting all of your working capital in a highly regulated environment, you need to realize the practicalities of that. And so now some potential solutions, which we'll go into more in other videos, which is that there are smaller private banks. Smaller private banks, you have to know them. You have to take time, research them, get to know them. I'm not talking about the ones on the front end, the dubious ones where, none of the directors or the owners are known, or they don't have any photos on the on their websites or anything. I'm talking about small private banks where you can actually get to meet the owners, get to meet the managers and the directors of these private banks, and they're transparent. They're definitely regulated. These private banks are an interim solution, because with smaller private banks, you can actually deal with you can make a lot more progress. You have much more ability to deal with the relationship managers and work out customized solutions, especially if you're dealing in small amounts of 5, 10, 20, 30 million dollars. So what you want to do then is split your accumulated wealth between what you need to leverage for the business and then what you need to protect for the family. So realize that there's a difference. Don't put all your accumulated wealth in the US, in large global brands, in highly protected environments, and then start screaming when you can't access that capital in a crisis to resolve the situation. If you're worth $50 million, I'm sorry, but that does not register for JP Morgan. If you have your, it doesn't matter. Yes, your relationship manager will welcome you. They'll onboard you. They'll set up your trust. They'll talk to you. All that routine stuff, routine is great. There's no problem with these guys delivering routine. In a crisis, though, you don't want to see what happens when there's a crisis. And so this isn't necessarily going to cost you more. It just means it's just a matter of doing the right thing and being smart. So if you're on the way up, you're growing your business, managing, you're moving, you're doing your strategy, you need to divide your capital, your accumulated wealth between the highly protected large brands and a more mobile, responsive, smaller private bank. It takes a lot of work to do your own research and find the right boutique private bank to work with. That's a task in a separate video in and of itself. We'll talk about that. But that's something that you need to be aware of, because large trustees and all these people are not incentivized to help you when there's a crisis. I've seen it. I'm happy to, I'm not calling any names, but I'm happy to, I would sit down and talk to any of them about what they would do if 1, 2, 3, 4, 10 things were to occur. What would you do? You can actually even find yourself in a situation where the trustee will actually, if the problem or the crisis got so bad that litigation was needed to resolve it, you can find a situation where the trustee company will actually stop talking to you and hire their own lawyers, using your money to resolve, to deal with the situation. And when I say deal, they're just sat back waiting. They've got lawyers for their own protection. They're not necessarily now focused on acting in your best interest. They're sitting back and using the crisis as an excuse not to do anything. It's only for large clients who've got hundreds of millions of dollars with them, where the relationship manager will run to the fore and get the cooperation of the bank. And if you're under $100 million, that does not apply to you. And long may it be the case that you don't have problems, but we have seen this. It's a real issue, and so this is why we're letting people know it's part of the education and reality that we're providing. So it's not going to cost you any more. You can use a smaller, more responsive private bank trustee, and then put your long-term protected wealth in the large global plans, and and then we'll have more videos about how to select, things that you can do to consider in selection. We're not going to recommend any particular private bank, but there are generic things that you can do to look and select for yourself. And that's it for now. Thank you.